That looks better. So I do want to make this interactive. So if you guys do have any questions, feel free to chime in, put it in the chat, whatever works best for you. These are prepared slides, but happy to go off script if there's any questions. So I would just see that as a guideline, not necessarily as basically just the only thing that we want to go over. If there's anything else, just feel free to jump in. So I'm going to start with this. I think the first time we looked at this was 3 years ago when we were at Skirball, and we were trying to talk about cycles and how cycles worked, and we were talking about yield curves. And the reason I'm bringing it up again is because over this past week we've seen that the yield curve, depending on how you calculate it, has potentially gone close to zero or inverted, and that's a bad sign generally for the economy. So I'll just walk you through the graph here for those who weren't at Skirball 3 years ago who don't remember. So in that dark black line is the 10-year minus the 3-month Treasury. And so that's basically the 10-year yield minus the 3-month yield of Treasuries. And you can see that since the 1980s. The black line actually starts a little bit afterwards, call it 1982, 83. And then you can also see in the gray line, the slightly less black one is the 10-year minus the 2-year Treasury. So the 10-year Treasury minus the 2-year Treasury. And then finally, the last curve in that purple or pink is the Chicago Fed financial conditions credit subindex. So you've got financial conditions, and there's 3 components to it. One of them being the credit subindex, the other 2 being risk and leverage. And the reason I put that there is because typically so the way that typical credit cycle works, or business cycles, which are often associated with the credit cycle, is that as the yield curve flattens, banks lend less. And the reason banks lend less is because they typically tend to lend on the long term, so call it the 10-year Treasury, and they borrow on the short term, on the 3-month or the 2-year. And so when the 10-year, so when basically their revenues that are linked to the 10-year drop below their costs that are linked to the 3-month, they can't make money anymore, so they stop lending. And when they stop lending, that usually tightens financial conditions, and that those financial conditions means lending sort of ceases, and that's when the equity markets start to get into hot water. And as you can see historically, and I actually wrote an article on this that I think is on the AAII website, which takes it back to the 1940s. But you've basically seen an inversion of the yield curve before every recession, and I think save one that was back in the 60s. And that is the reason, because that process of the bank stopping to lend and sort of the credit cycle, the credit liquidity decreasing. And so what we saw this past week is that the 10-year minus the 2-year basically it came close to inversion, but the 10-year minus the 3-month isn't there. And there's even a Fed paper that says that the 10-year minus the 3-month is actually a high determinant of a recession. They wrote it. They put an onus that it has to invert for about a full quarter for it to be significant. So this is something that the Fed looks as well. And during his speech the other day, I think it was at the Bankers Association, Chair Powell alluded to that paper that the Fed had written a while back now. So I just wanted to say we've got sort of a warning shot that the economy is problematic, and that's linked to the fact that there's been a lot of head hikes that have been factored in since the beginning of last year. So you can also see that there's a divergence between the 10-year minus the 3-month and the 10-year minus the 2-year. So the 10 minus the 2-year is close to zero, whereas the 10-year minus the 3-month has been going up. And that just comes from the fact that we're currently at the beginning of the hiking cycle. And so the 10-year minus the 2-year is sort of factoring in all the rate hikes that we'll see over the next year, while the 10-year minus the 3-month is like saying, well, right now we're only at 25 basis points, so it hasn't really factored in the cycles till the end of the year, the rate hikes, sorry, until the end of the year. So there has been some press about the fact that these two curves that are diverging mean that the signal is not clear. No, it just means that if we keep on this path, that black line is going to join that gray line and it's going to come down if the Fed does what it said it will do over the next sort of 12 months. So it's sort of an early warning that there's something problematic problematic that's to come. But again, it takes a little while for these things to follow through. So it's not like it's instantaneous. In addition, the Fed can always react to this and avert sort of a liquidity crunch if they pour in massive stimulants. The same way we saw in 2020, they just went all in and they basically averted a recession by overcorrecting and now creating inflation. So we'll go through these slides and you'll see there's some things that are slightly problematic on that. I wanted to point this out because there's a new writer on Substack called Alfonso Pocatelli that I found pretty good, and he talks about sort of yield curves, but he uses different measurements called the OIS, or the overnight interest rate swap, which is a similar thing. And he observed as well that there's been some inversions on those yield curves. So the overnight interest rate swap is basically just the sort of the spot rate of the 2-year versus the spot rate of the 10. It's as if you were 10 years from now, what would be the overnight interest rate, and then what is the interest rate 2 years from now? It factors in less credit risk or less term premium than the treasury curves do, but similar sort of result on that one. As you can see, the 10 minus the 5, the 30 minus the 5, and the 10 minus the 2 are now going towards 0, while the 10 minus the 3 is still quite high, but inverted, and this inverts like it did in 2020 before the recession. So we talked about financial, that pink line, one of the components of that pink line. So the credit subindex, the financial conditions credit subindex, is credit spreads. It's actually one of the big components of it. And this is a slightly surprising to me, because even though the equity markets haven't fully recovered, it seems like credit spreads have started to contract, which is a positive for the equity markets. So what you can see on this graph is the blue and the green are basically two different measures of credit spreads on the BBB corporate bond yield. So that's the lowest investment grade bond. One is Moody's and the other one is the Bank of America option adjusted spread. The reason there's a slight difference is that Moody's subtracts the 10-year treasury, whereas the ICE B of A, so that's ICE, that's the Intercontinental Exchange, Bank of America BBB US corporate index, does it versus the exact maturity of the specific corporate bond. So it's, instead of just taking all the bond yields and subtracting the 10-year treasury like the blue line does, the green line takes every individual bond and subtracts the perfect maturity of that bond and then looks at what the spread is. So it's a little bit more accurate. The reason I put both of them is that the blue line, if you were to pull it back, goes a lot back further in history, whereas the green line doesn't have as much history. That's the only reason why. So if you're looking at long-term series, you're probably going to be looking at that blue line. If you're looking at a more recent time series, you'll probably be looking at the green line. And then the red line is basically the Wilshire 5000, which is just another measure of equity markets, just like the S&P 500, and it should be basically highly correlated. So what I wanted to point out is that typically what you see before recessions, and this shows it here, is that you get a crunch in the financial conditions index, credit index, before it rolls over. That's sort of like the straw that breaks the camel's back, is essentially the lending stops, the conditions tighten, and the economy then rolls over. So you saw a little bit of the tightening with that since the sort of end of 2021, around December, but that has actually more recently reversed, and so that's quite positive on the equity markets. Part of it is due to the fact that the equity markets have rallied, but it's surprising because if you look at the parallel in 2018, end of 2018, the reversal took a little bit more time to turn around than what we've seen here. So I'm actually positively surprised for the equity markets here that the credit spreads seem to be trending in the right direction. To be continued.
Can I quick question
Sure.
on that?
Please jump in.
Do you look at the two ETFs, the HYG and LQD?
Yeah, of course.
Because both of those still have dropped quite a bit, and they're having a hard time to try to recover.
Yes. So the slight difference between this and the HYG and the LQD. So LQD would be investment grade, so it would be basically slightly higher credit than the BBB, or on average it would have higher credit than the BBB, and HYG would on average be credit that's lower than BBB because it's the junk bonds. However, because there's increased in yields it doesn't represent exactly the same thing, because here we're looking just at the spread. So it's as if you looked at what the spread of the credit was versus sort of the risk-free rate or the treasury bond, whereas LQD incorporates some treasury effects, so some interest rate effects. Does that make sense?
Yes.
Okay. So this should be it should be a slightly more precise measure of that sort of that financial conditions or credit spread. But I agree, the LQD or HYG haven't well, LQD especially hasn't recovered that much, and that's because yields, as you saw, the 10-year has been going, it keeps going up for some. It just keeps going up. It probably linked to the fact that the Fed is just talking about hiking a lot. So what's going on? Why is the Fed hiking, and sort of what's the situation? So the Fed has a dual mandate, which we've talked about before. It has the mandate of price stability, and it's got the mandate of full employment. On this graph, you're going to see inflation, which is linked to that mandate of price stability. So the blue line is the consumer, the CPI or consumer price index, less food and energy. So it's core CPI, and that turquoise lighter blue line is headline CPI. So it removes the volatile effects of food and energy. And then the green line is trimmed mean PCE. And the reason I put that there is because Powell last year alluded to the fact that they were not looking as much to, they were looking at other measures of inflation that were sort of averaged and that weren't as volatile as potentially the core CPI. But and he was using that as a way of saying CPI has not gotten out of CPI or inflation hasn't gotten out of hand because the trend mean PCE hasn't really gone anywhere. Well, you see in the last sort of 2 months that that measure of inflation, even the trimmed mean PCE, has spiked up. So even sort of one of his more loose measures of inflation is starting to spike, and so that's causing them concern. And that's also why they're starting to get aggressive on hiking. And of course, the core and the headline CPI have gone pretty damn high, almost at 8% on headline CPI. This is a way of decomposing the CPI or inflation. So inflation is composed of services and goods. And so the blue line and the red line are two different types of goods, the durable goods and the non-durable goods. And the green line is the services. So typically what we've seen over the past decade is that durable goods didn't really they sort of were deflationary. And a lot of people talk about the China effect, the fact that you had cheap labor that was producing these durable goods like your refrigerator, your TV, and they were deflationary, whereas non-durable goods or more consumer goods were sort of the main source of inflation with services. And non-durable goods have been a lot more volatile. But what happened also during the pandemic is that people started buying a lot of durable goods because they were stuck at home, and that started spiking. And so no one was too surprised that the durable goods inflation went up. But then you've now had the non-durable goods, and you've also had the services that have started inflating. And that sort of puts another nail in the coffin of saying, well, there's a little bit too much inflation going on right now. And I'll pause there if there's any questions.
Yeah, I do have a question. A lot
Sure.
of times when I hear a lot of Powell interviews, and nothing scares the guy too much, but every time I hear that inflation expectation going to get unanchored, he gets really, oh no, we're going to put a stop to that. What is the best way to measure inflation expectations? I know there's a few different ways, but what do you think is the best way?
This way. Perfect segue. So one of the ways to measure inflation expectations, and usually the one that's used quite a bit, is that 5-year forward inflation expectation rate. So the way this is calculated is through TIPS, Treasury Inflation Protected Securities, and so those you've got a few different maturities, but there's the 5-year and there's the 10-year. So if you take the nominal Treasury and you subtract the real yield, you get the inflation. So the TIPS trades as a real yield. That's the Treasury Inflation Protected Security. The nominal Treasury is the normal Treasury that you would buy and sell every day. So if you take the difference between essentially the yield on the nominal Treasury and the yield on the TIPS, you get the break-even inflation rate. And so that's what's plotted for the 10-year in green and for the 5-year in red. Now, because you've got those two maturities, 5 and 10, and so it's basically what is the inflation rate that's trading over the next 5 years, and what's the inflation rate trading over the next 10 years. So if you can basically deduce what the inflation rate is from 5 to 10 years, starting in 5 years and going 5 years out up to 10 years. And that's what the 5-year forward inflation expectation rate is. So it's the inflation rate that you would have over the 5-year period starting 5 years from now. Does that make sense, JC?
Yes. Now, is there another way where actually it's more of like a consumer-based questionnaire with what they think is going to happen? Is there another?
There are 2 other measures that at least I know of, and there's probably a lot more, but the typical ones would be the University of Michigan inflation expectations, and that would be on FRED as well, on the Federal Reserve Economic Database. And then there's also the Philly Fed survey, which is they go ask economists and they survey them on what they think the inflation rate will be going forward.
And do you know how those 2 are compared to this break even?
What I've at least, and I don't know what they are exactly now, but what I've noticed that typically those surveys tend to be highly linked to what the current CPI is. So I tried to do a study and see if using the inflation expectation index, I could reproduce TIPS, the Treasury Inflation Protected Security, because TIPS only started trading in the 2000s. So, but the inflation expectations of the Philly Fed survey are older than that. So one of the thought I had was to can I reproduce what a TIPS curve would look like from the 1980s to 2000, call it. And what I found is that the inflation expectations index for Michigan is often very close to what the core CPI is at that time. So consumers basically are anchored at what the core CPI is, and they don't really look that too much forward. Their inflation expectations don't change too much from what today they're reading on the core CPI.
So probably the Fed is not paying too much attention to that. They're more paying attention to this 5 and 10 year break-evens.
That's what I would have thought. And the ECB, for example, has openly stated that it looks at the 5-year forward inflation expectation rate, because that's a market measure of where inflation expectations really are. And if you look at that one hasn't really changed too much. It's still around sort of slightly above 2%. However, recently the 5-year has started going up. So if you take the green line out, you've got over the next 5 years, the inflation rate has started to get punchy. But beyond that, the inflation rate is sort of back to its old normal, if that makes sense. And this is headline inflation, right? It's not core inflation.
Right.
So right now, I wouldn't say inflations are de-anchored. People are still thinking that right now there's going to be a big bump in inflation sort of in the next couple of years, but that it'll revert back to sort of its old mean going after that. And yeah, just to show the Eurozone inflation. Sorry, someone else had a question?
Yeah,
Sure.
Just real quick, is it possible to record this?
I believe
it's hard to keep up with sometimes.
Oh, sorry. I believe it is being recorded. Yes. Yes, it is being recorded.
Then how do you listen to it later?
I will download it on YouTube, and then I'll send a link through AAII.
Perfect.
And Meetup.
Thank you.
Any other questions? So I wanted to show this because this sort of represents the effect of energy.
I can't freestyle.
Just go for it, bro.
I got an iPhone 13. I shoot beams, 3-point, no team. I'm alone. I got bones. I got phones. I got.
There we go. So this is the Eurozone inflation rate, and there's what you can see is that this started a little bit earlier because Russia started playing with their, especially natural gas, in around the beginning of, call it spring of last year, and that's created a lot of inflation in Europe. So you can see that now more than half of the inflation increase is due to energy prices, and that's linked to sort of this Russia crisis that we've been seeing. There's still the inflation rate. If you still take the remaining piece, it's sort of like 3 to 6, so that's about 3%, which is still pretty high and above the sort of the 2% maximum that they've seen historically. But a lot of it is due to the energy crisis, so they're thinking this will come off. And this I thought was it's an interesting graph. So this is part of the reason why, to JC's point, the Fed sometimes thinks inflation expectations can get de-anchored, people tend to be worried when wage inflation starts getting out of hand. So this is basically a long-term look at what the increase in wage prices are, because when people get paid more, they're willing to pay more for products, and that tends to be a virtuous or vicious cycle, however you want, where wages increase, prices increase, and then just keeps on going. And that's often what people think about in the 1970s. But there's two things to take away. One is that we haven't had this type of wage growth in the past, call it what, 40 years. And this is not the first time you've had these bumps in wage growths. And further down, I'm gonna give an analogy of the 40s, but during wartime periods, you've had these bumps in wages just to do sort of to constraints in the labor force, which is similar to COVID, that have mean reverted pretty quickly. So while we're spiking right now, I'm not, that's worrying in itself. There is still the possibility that this thing mean reverts and that this wage inflation isn't as worrisome as we see it. And plus, when you look at it in the grand scheme of things, we're at 5%, and the really problematic piece was sort of north of 5% in sort of the 70s. I'll pause there to see if there's any questions. Labor force participation. So the labor force participation rate is the second mandate. So we talked about the first mandate was inflation, and the second mandate is unemployment. So as you can see, unemployment started coming back down. We're almost back down to the pre-pandemic levels, but the participation rate hasn't gone up. So I think the Fed is now I don't think they've completely achieved what they would consider full employment, but they sort of ignored it because inflation has taken the front of the scene. If inflation were to subside, they would probably go back to more focus on this because they still haven't, I'd say, achieved pre-pandemic levels. If you look at their participation rate here in blue, they want to get it back to the sort of that 63%. It's on the left-hand side, and that an unemployment rate, which is, call it around 4%, they want to get it back sort of around 3.5, which was pre-pandemic. So that objective they haven't really received, but they've shifted their focus more to inflation now. Another thing that sort of is in the camp of inflation less worrisome is the initial jobless claims, which is a measure of the number of claims that you get per week for unemployment benefits. And that's now, again, that's actually gone to below pre-pandemic levels. So again, it puts less emphasis on the employment mandate that the Fed has. So this comes from, so on the left side of the graph, you have historically the probability of rate hikes until from now until December at each point in time. So the probability that so 8 rate hikes, so that's basically 25 basis points per rate hike. That means that the Fed funds rate would be at 2%. And the probability that the Fed funds rate is 2% is close to 100% by December. So we're talking about having and if you go back to that yield curve that I mentioned at the very beginning, we're talking about basically having this, the 3-month go to 2% by the end of the year, which basically means that black line would probably be hitting the 0, right? Because you've got about you've got a little bit less than 2%, so it would invert. I want to make sure people are understanding the logic I'm using. So please chime in if it's not clear. But essentially, 8 rate hikes is basically hiking to 2%. So that black line, that's, call it around 1.9, that would go down to 0, and so you get an inverted yield curve. So if that the Fed, because of all the talk it's had, and it's basically gone from a very low probability, even beginning of March, of 8 rate hikes to basically almost 100% probability. So basically a 2% Fed funds rate by the end of the year. And this on the right graph is something I picked out that I thought was quite interesting. It shows basically what people are sort of assuming how they would get to those to basically the rate hikes by the end of the year and then beyond. So here they're basically saying we would get to 2.25 because it's a 25 basis point window, so it's from 2 to 2.5. And then there's even an assumption that they would potentially be hiking beyond that. And the assumption is that the next meeting, they do a 50 basis point hike, another 50 basis point hike. So we're talking quite aggressive. And then the third one, And this is what the futures are pricing in. And then they would go on 25, 25, 25, sort of second half of the year. That's a pretty aggressive hike. And to that point, there's this graph that I thought was interesting, which shows rate hiking cycles and how aggressive this one is versus other ones. So if you look at that, that's basically the current rate hiking cycle and how steep it looks like. And that's basically what you see here on the red line here. And you see it against other rate hiking cycles historically. It's basically the one, if not the most aggressive rate hiking cycle we've seen over the past 20 years. So it's quite aggressive. And the question is when do things start to break down, and when does the Fed need to pivot because it's just too aggressive? I'll pause there, see if there's any questions.
I did have one question about the Fed's balance sheet. I wanted to get your thoughts about, an $8.9 trillion balance sheet. What do you think they're going to do as far as when they're going to reduce that balance sheet, and how much do you think per month they're going to do it? They were adding 120 billion a month, for the past few years till recently. And what do you think when they do, do a balance sheet runoff? What do you think that amount's going to be per month? If you have any opinions on that.
I don't have a big opinion on that. I feel like at least my take is that the balance sheet is less important at this point than the interest rates, because the interest rates are really sort of the guide of the economy. The one thing I do think the balance sheet runoff might have an effect on is mortgage rates. And I think I put in the resources an effect that it might have on mortgage rates, because they have a lot of MBS, and depending on how they sell their MBS, they could potentially increase mortgage rates, so the spread to treasuries. I think that's the sort of the larger risk, is how aggressively they sell off their MBSs, their mortgage-backed securities, because that could hit the housing market, which often tends to be a big part of sort of the wealth creation and sometimes is a predecessor of a recession.
Hey Daniel, this is Drew.
Hey Drew, how are you doing?
How you doing, buddy? Great to hear you talking again. In that same vein, if they go up to 2 by the end of the year, is that going to be pretty much a direct correlation to the mortgage rates? If they're at 3.5 now, they'll be at 5.5 by December, you think?
I'd say the mortgage rates are probably more linked to the 210. Well, sorry, the 10-year, and the 10-year doesn't necessarily go up 1 for 1, and that's because it tends to invert. So you'll probably get an increase in mortgage rates, but I don't think it'll go up as much as the front end of the curve, especially if you invert the curve.
All right.
And that's what's happening right now.
The mortgage rates already went up from a 2.65 30-year fixed, back last year, and right now it's sitting at 4.875. And that's that's
so the
just with the one rate hike.
So the mortgage rates are factoring in just as much as the yield, the 10-year yield is factored in. But Fred has the 30-year mortgage rate. I'll bring that up while we're at it. Just give me a second. Put it into context. I like the deviations. It keeps me on my toes. Where is it? New share. There we go. There we go. Can you guys see that?
Yes.
Cool. So this mortgage rate is going to be highly linked to the 10-year constant maturity. See that? So there's what's happening here is the mortgage rate. We're at a low, sorry, call in summer of last year. They've spiked quite a bit. You had a contraction. Surprisingly, the 10-year hit a bottom sort of in 2018. You had a contraction of mortgage spreads because the Fed was buying during the pandemic. And now, because they're talking about the runoff, in the balance sheet, mortgage rates have started adjusting to upwards, but there's a big component of that that's linked to the 10-year. Does that make sense?
Yes.
Okay. We were here. Okay. So the other thing I want to show is that the GDP, so this is an estimate of from the Fed, Atlanta Fed, of what GDP growth should be over the next quarter. So this one would be the estimate for Q1. Hasn't come out yet. And for Q1, the estimate is is basically that it's not going to be great, right? We're talking about 1% GDP growth compared to last year where we were talking a few percentage points of GDP growth. So that shows that the economy has overall been slowing. And if you look at here, this is basically the spread of what economists are predicting, and it's been coming down over since end of last year. And then the GDP now is used it's basically a regression type of model that's based on economic estimates. And they've always been pretty low, sort of around the 1%. So we're not looking at stellar growth going forward. This will also be in the slide deck. There's resources that I'll share. This is basically the M2 money supply, and it comes from an article from Scott Minard, which I found was quite interesting, who compares the current situation to the 1940s and the post-war era, which is a very close, which I think we've made the analogy before between the 1940s and sort of the current period. And what you see is that a lot of people talk about inflation and money supply driving that. What you say in the post-world during the Second World War is that a huge creation of money supply. It trailed off, and that's a lot what's happening now. So inflation was a little bit bumpy during that period, but came off fairly quickly after that. And these are two representations of these periods. It might be a little bit involved to get into this, so I'm probably not going to do it over the presentation, but they'll be in the slide deck. So if you guys want to take a look at it, it's sort of you've got the 1940s on this slide, and then you've got the current situation on this slide, and sort of the different economic indicators that you can use between unemployment, equity markets, inflation, GDP, and then unemployment. So there's a few other interesting things that are going on in the market. So one, we've got aggressive hiking, so that's a little bit worrisome for the markets overall. The inversion of the yield curve is not a good thing, but it's the 10-2 and not the 10-3 that's done it yet. So we're not completely against a wall. The BOJ on the other side is still in hiking mode, and still in easing mode. They still want to keep that their interest rates down. And so what you saw a huge devaluation of the yen over the past 3-4 weeks due to that, because basically they have said we're going to try to keep a cap on our 10-year on our yields, and therefore what adjusted was the currency between the dollar and the yen, and the Japanese yen has basically been going down quite a bit. The problem with this is if they potentially are keeping part of the system supplied with liquidity because of this, but if they get excessive amount of inflation, they might need to reverse this policy, because as their currency depreciates, that's going to create inflation, because for example, they import a lot of energy, and so they might need to reverse that, and that could be another element that rolls over that creates a tighter liquidity situation in the system, because they're providing a lot of liquidity right now.
A quick question on that, Daniel. Most of the central banks are, either bringing rates higher or even doing,
Yes.
the reverse of quantitative easing, quantitative tightening. But the only central bank not doing that is Bank of Japan. So
Yes.
they're taking all the pressure, doing their curve control.
Yes.
Just tons of, they have to buy so many of their. So do you think that if for some reason they have to change policy, how do you think that would affect the world markets?
Well, I think that
if
would
they're
be
the only ones helping out the whole world doing this.
So that's why I think we need to look at this, because if the Bank of Japan reverses its stance, that means there's a lot of liquidity that'll be supplied to the system, and that could be the precursor of a sell-off, is the way I'm thinking about it. Because if they're not supplying the liquidity and there's just not enough, if the liquidity dries up too quickly, then that
it would
usually
be pretty much
tightens
catastrophic for
conditions.
bonds, right? For world bonds.
Yeah. You could see interest rates go up. You could see the whole system, the yield curves invert more aggressively. You could see equity markets sell off. So I think right now one of the things that's important to look at these days is probably the USD yen exchange rate, just to see how that flies and what the Bank of Japan is doing, because like you said, they're the only big central bank that's still in easing mode.
And right now they're right up against their peg, right, of a quarter. So they have to come up with some plans.
They're going very aggressively, yeah.
Right.
Okay, yeah, a few other things. This was more of a sort of an interesting side note. It's sort of what the different S&P 500 sector level bottom up target prices are. This is by analysts. So they surveyed analysts and they said, well, what sector do you think has a better chance to outperform versus its current closing price? And you'll see that communication service was on the top, consumer discretionary, infotech, S&P 500, financials, industrials. At the other end, you have materials, utilities, and energy. And so basically you've got the safe type of assets, or the that are sort of in the middle, and you've got essentially the sort of the growth assets that people are still thinking of. Some of these growth assets are going to outperform. So infotech, consumer discretionary, and then what's been performing over the past 20 or sort of the past 2 years, I guess. People are saying they're not going to perform as well. Sort of the energy and the utilities. Utilities typically never tend to perform well anyway, because they're low growth and they're low increase. But energy and materials have done really well over the past sort of 12 months, and they're now saying they're not going to do as well. I thought it was interesting. There's not really a big conclusion out of this, but I guess the way I'm thinking about it is that the market still thinks that what worked for the past sort of decade is still what's going to work going forward. If you look on this left side here. So they're probably, it sort of indicates that they think that the Fed might reverse their policy and be less aggressive going forward, because they think then that infotech, consumer discretionary, which are interest rate sensitive, might be they're long duration assets. They'll do well going forward. I did want to bring up something which is the midterms, and part of the reason I think the Fed is so aggressive, especially this year, and we're talking about 50 basis point hikes. We talk about like in the next 3 meetings, and that's before the midterms. The midterms are on November 8th. Is that currently the Fed and is really aligned with the administration, and the administration, and Biden's put this forward, is the administration really wants to show that it's fighting inflation. And it's basically, I mean, Biden, I remember him even saying, he didn't say we instructed the Fed, but it was basically meaning that the Fed is going to hike to stop inflation. I'm not sure that first of all, energy, there's not really much that the Fed can do to stop energy unless it creates a recession, because the energy is just, you take out 15% of the world's supply of crude oil, it's going to be problematic for your price increases. It's going to create a bad price increase. But on the flip side, the other stuff, they want to be shown that they're doing something. And so I think part of the Fed stance currently is linked to the fact that there's midterms on Tuesday, November 8th. And right now it's also linked to the fact that the Democrats are losing.
That's very nice.
So the administration is really starting to try to pressure the Fed into basically being aggressive on inflation. And one of the interesting things is, the Fed, the Powell was basically renominated in February, we'll call it around February 20th of February, but was only confirmed about a week ago as chair. In between that, if you look at the probability of increasing the Fed rate hikes, that's really when the increase in so he was nominated around here, and he was confirmed roughly there, right? And this is basically the administration trying to show that it's getting tough on inflation. So a lot of the stance from the Fed, I think, could be linked to the fact that the Biden and the Democrats want to show that they're doing something about inflation. And they've been in a losing situation. So here you can see what the historical betting markets showed, and basically it means here started sort of summer of last year was a 50-50 chance that it was the Democrats winning the midterms or the Republicans. And roughly, if you look at it, the August situation, which is basically Afghanistan, started the downfall of that trend of the Democrats being basically 50-50, and it really started getting the Republicans more likely to win. So these are both betting markets. This is a U.S. version, which is not as I'd say as liquid, because they don't put a lot of money. They just bet like dollars. This is the UK version. You can only bet on this in the UK, and there's about $88,000 at risk here. But so it's not huge, but it's substantial. And if you do the ratio here, because it's the odds, so if you do 1 over divided by 6.4, or 1 divided by 1.2 is basically 75%. It basically says that the Democrats are losing. So they're really trying to do something to try to reverse that situation by November so that they don't lose the House. And I think part of that agenda is telling the Fed to hike aggressively to show that they're doing something on inflation. That's also why Biden released the strategic petroleum reserves recently, to show that he's trying to bring inflation down, that he's concerned about the consumer. They're really trying to show that they're doing something. And so I think a lot of the policy right now is driven by that. And I'll pause there. I'm sure JC has a comment on that one, no?
Well, I mean, the only thing I think if the Republicans win, probably nothing is going to get done with a mixed, House and Senate and presidency for the next 2 years,
Yes.
because they need 60 votes to pass anything in the Senate. So obviously, if the Republicans take the House, nothing will get done except for executive orders.
So that's exactly so the first takeaway is that the stance on hiking probably doesn't change until sort of closer to the November deadline. The second stance is that if the Republicans do basically regain the House, that means you've got gridlock, and you're less likely to see big stimulus packages. So that's also likely to see less inflation. So you won't probably see an infrastructure package. You won't see another big stimulus package. There's a lot less things that are likely to pass that are inflationary. So what have we seen recently? So this is basically the S&P 500. I just updated the graph that we showed last month. You've seen this rally here. We sort of stalled today over the past few days around this area on the S&P 500. I still think we're probably in a little bit choppy. I'm surprised we rallied as much from where we were here up to here. It still feels like we need some sort of a resolution on the rate hikes. The rate hikes keep going up, and as the rate hikes keep going up, it would seem that's hard for the market to rally or to make new all-time highs. Again, famous last words before it happens. We aren't sort of in recession mode yet, because the 10-3 hasn't inverted. The 10-2 is showing early signs. So there's probably still some runway to go, but the current environment is not very conducive due to the very hawkish stance of the Fed.
I did want to bring up one point as far as
Sure.
The balance sheet runoff. I think is extremely important, probably just as important as rates. And the reason I say that is because I don't know if you remember, like when the Fed minutes came out, and they actually had something about doing something to a balance sheet, the market panicked. So it's telling me that it really cares about the balance sheet runoff as far as the speed of it. The bulls they want to postpone that and maybe go real small, 10 billion a month. But the bears, they want 120 billion a month, just the same amount they were putting in every month. So I think that may be significant when they come out with those decisions there.
So maybe on a headline basis, I think that probably makes sense. But the way the Fed manages the balance sheet is really a way to facilitate interest rates or sort of liquidity in the market. And it's a way for them basically to get the interest rate where they want. That's really why they were using the balance sheet in the first place, and to stabilize the market. But yeah, I get your point. Then I put sort of the technical indicators again. So these are updated as of the close today. This is basically the number of stocks on the New York Stock Exchange in blue that are above their 50-day moving average. Currently, we're at 43%. So there's more stocks that are below their 150-day moving average than that are above. Typically, it's not a very bullish environment when you don't have a lot of market breadth. So if you have below 50% of the stocks that are under their 150-day moving average, that's typically not very conducive to good equity returns going forward. And then the other measure of market breadth is sort of this advanced decline line. It's basically you take the number of stocks. The blue line is the number of stocks that are up minus the number of stocks that are down over that day, and then you just add that on a sequential basis. And typically, when you break to new high after a consolidation, like you did here in, for example, end of 2018, that usually starts the trend of another bull market. It is lagging, as you can see, but it tends to be a good way of seeing if you're out of the woods or not. So I think one of the conclusions is that we really have the market's rallied, but this feels more like a bear market rally, and that we're probably going to see a little bit more chop going forward. And then here are a bunch of resources. So some of the stuff that you might be interested in, I put the Substack on the yield curve, how the Federal Reserve works and how it's going to change, who's going to change on the seats. The fact that Powell was basically confirmed, and then this piece from Scott Minerd, and then the piece about the Bank of Japan and how the forex markets reacted to the Bank of Japan on easing mode versus everyone else on hiking mode. And that's it for me. So if you have any other questions or stuff that we didn't touch upon that you want to bring up and that we should discuss, let's do that now.
I did want to bring on one I wanted to get your input on if the Fed is going to be raising the rates, quite a bit this year. When do you think they're going to start thinking about when they raise the rates too high? All they're doing is basically getting the interest rate, all the stuff that they own on the balance sheet, to have to spend a lot more money on interest on the fund that they own. So it's going to have come into their calculations when they start going too high, because we never had the 8.9 trillion before in the history of the U.S.
When you think that they're gonna walk back, well, one of the reasons I was saying they're probably not walking back anytime soon was because of these credit spreads. Like typically the last time that Powell backed off was when these green line and blue lines basically hit 2%. You had that sell off, and then it hit 2.5. If you remember, Powell basically backed off when he saw credit spreads going haywire. Here, credit spreads haven't really reacted to that so far. They haven't really hit those levels. So he doesn't have any. Sorry,
and also back then they didn't have any problem with inflation, so they could have backed off anytime they wanted to. This time around, they do have a problem with inflation, so it's hard for them to walk anything back.
Well, that's why I'm saying till the midterms, it's the likelihood that they back off really needs to. You almost first have to wait till the green line here hits 2% and the blue line, call it 2.5, and then you have to see how bad it's going to be. And even then, I'm not sure they're going to back off until November 8th, because I think the Biden administration is going to want them to hike. I mean, you saw this is the most aggressive hiking schedule, and the only reason I can think this is the way it is because inflation is so high, and that the administration on top of that wants to show that it's doing something.
But don't you think if he's already nominated for a term, he doesn't really need to listen to him?
I mean, he used to work for Yellen, and there was probably the fact that it took a month for him to get confirmed. I don't think I would guess that there's sort of an understanding between Powell and Biden at this point. And during that month, that's the month where the expectations for rate hikes just went through the roof. I think he could walk back a little bit more now that he's confirmed, but I still think there's a lot of pressure there for him to put the high rate hikes. And like you see here on the projected one versus the probabilities, all these rate hikes are front loaded. They're before November. Like the 50 basis points here, all three of those 50 basis points hikes are before the November midterm.
Yeah, and the biggest pressure is a 7% CPI. And
Yeah,
we'll
it's a
see
huge
what
amount of
happens
pressure.
when the April 12, we'll see what number comes up there.
But that's a pressure because the Fed needs to hold its mandate. But from a market expectations perspective, that's a short-term effect, right? So it's true that the headline number is not great, but the 5-year hasn't, that sort of the forward expectations haven't delinked. The next 5 years have delinked a bit, but the longer term, the 5-year is considered like what's the long-term inflation expectations. Those are basically still well anchored. They haven't really gotten out of hand. And the ECB, for example, that's one of the things it looks at to see if it's gotten out of hand or not. So I think there's pressure just from a sort of a headline effect more than really a fundamental effect.
And to maintain a credibility too.
Yes, maintain credibility, but right now there's no real reason. It's not like inflation's run away at this point. The 5-year is still really within the normal range. Any other